Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. Final Wednesday in the fine month of September, 1 o'clock on the East Coast. Gaius Adami is here. Of course, that's from T-Bug, clearly channeling his, what was that movie with Russell Crowe, Gladiator? You know, it would have been a kick-ass Gladiator.
By the way,
you know
they have a sequel to it coming out in November.
I saw that.
Is it with Russell
It looks
Crowe?
awesome. Now,
Denzel's
there'll probably
in
be
it.
some, he died. You know, spoiler alert, people, at the end of the
Russell,
first one.
apparently, so the kid in the original Gladiator was the son of Maximus. They didn't tell you that at the time, but I think we're learning that now. Yeah, I think that's what's happening here. If you go and watch the trailer, you'll see that your father, blah, blah. Anyway, Amanda's like, oh, my God, why are you doing this?
She's like, oh, my God.
Yeah. Well, look, Elizabeth Young-Thomas is here, wearing a little denim, which I dig.
EYT.
We were just having a conversation about the football game that I wasn't invited to, but you two went to, which is fun.
Can we tell that story? We're going to tell that story really quickly.
We're going to tell that story.
So what was it, 2 years ago, NFC Championship, the 49ers are down at the LA Rams in SoFi Stadium. Now, EYT is obviously, the face of SoFi. And so she invited me. It was a very late invite, by the way. It was a Sunday afternoon or evening game. I think I got it on Thursday. So I fly out to LA. I meet you there. We go to the game, and there's a line a mile long, like to get in. And it's like 45 minutes before. And we're like, listen, I don't wait in lines, guy. I know you would never do this in a million years, but it's like, go up to the guy at the front of the line and tell him who you are. You're Mrs. SoFi. Like, pull out your ID on your browser, go to the website. And she did it very sheepishly.
Oh, I was mortified.
I know.
Mortified at the idea.
That's not how you roll.
But I knew he wasn't going to let
But we
it go.
got in.
I tiptoed up to the front and I very sheepishly tapped the guy on the shoulder. Said, excuse me, sir. Would you please let me and my friend in? Anyway, we got in. It was a great game. Dan will someday be great.
The Rams won. It was super fun. The Rams had the same result as they had on Sunday versus the 49ers.
Yeah.
So it's interesting what you just said. So you said you got an invitation for an event that was pre-planned. I mean, it's not like this event came out of nowhere, this football game. So you got invited to something that was out there for quite some time, a late invitation on Thursday.
Guys. So first dibs on the tickets to the stadium and any of these events go to clients and partners because we're trying to build a business, right? The tickets that are left, if there are tickets left, usually we don't really know that until the last minute, until somebody's canceled or until there just aren't seats that are full. Then perhaps if you're in town, you can take them as an employee. So I don't get that much forward warning about the tickets being available.
No, because I mentioned that, and this is not to cast aspersions at Elizabeth. I just mentioned that because let's say you invited something on like a Tuesday for a Monday event that clearly had been planned weeks, if not months ahead of time. One would say, maybe that's sort of, I don't know, sort of an afterthought invitation, but that's
how many people did she invite before me? There's one question.
0.
The other question is, the reason I thought of this is that I was texting with a buddy of mine who's the QB coach for the Rams this morning. I said, great, win against the Niners. So I kind of and I told him I was there for the NFC Championship a couple of years ago. So I said, get to the Super Bowl, and I'm coming to the Super Bowl. Like, that was like how this conversation. You know what he said? 70% of the people in SoFi were Niners fans, which is pretty fascinating. Now, Niners fans travel. All right, so we get to the rundown here. We got a lot to. We got a lot to do.
If it's Wednesdays, it's Butters. I hear Amanda's. She's apoplectic. 4 minutes in, and like people.
Turned her computer on.
New highs. Now what? FXI. Mind the gap? Question mark. Micron earnings preview. That's later today. And if it's Wednesday, it's Butters. Wall Street strategist too bullish. It's interesting. John obviously, or Amanda obviously knows the difference between TO, TWO, and TOO. Yet there's still some people out there, prominent media people, that seem to have difficulties with that. Not that complicated. So you can tell that I'm in a mood today. So let's get into it here. And let's take a look at our first chart, which of course is the S&P 500, which today, Dan, made a new all-time high, get a gain, but is reversed a little bit. So it's going to be interesting to see if we have the potential for what I like to call a bit of an engulfing pattern, a lot of day left. but it's obviously out there right now as we trade about 57.20 or so.
Yeah, this is usually Liz's turf. I read this morning that today's new high is the 41st new high of this year, which is interesting.
That's
when you think
wild.
about, we had a couple sell-offs. We had that kind of 5%-ish, maybe a little more, maybe 6% sell-off in the spring. We had that from the high in July to the low on August 5th. That was about 11%. And then in early September, it was about 5% or so. And, every dip has obviously been bought. We're conditioned to kind of that, over the last, call it whatever, 15 years or so. I don't know. I mean, listen, it's a hard one. We broke out new highs. Liz, we've been talking about what would be the condition that you would establish a new range in the S&P above those prior highs. What were we, 56.60 or something like that? Here we are right now. It's 57.20. How are you feeling about this S&P right here? We're up 19.5%, nearly 20% of the year. We go into this period, everyone's freaked out about October. We know we got an election in early November. We got all these geopolitical hot spots. I guess the good news is that the Fed feels confident about inflation, but they are lowering interest rates to kind of buffet whatever people want to say on the downside about employment.
Yeah, I mean, right now at this juncture, I feel okay about it in the sense that there hasn't really been concrete evidence that the market should go terribly down yet. And I've talked about this a lot, the fact that the economy right now is at this balanced state. We're balanced in the labor market, one job open for every unemployed worker. We have cooled off in inflation. GDP hasn't taken a big hit. In fact, it's actually gone up. Expectations for the third quarter GDP have gone up. We've still got retail sales hanging in there. We've got corporate earnings results hanging in there. There's nothing out there that says the market should absolutely fall out of bed. So right now, I think it's okay, but I have been concerned, and I continue to be concerned, that we're just making a pit stop at this balanced state on our way to weak. So the concern really is that the market has seemingly decided the soft landing is here. The soft landing has occurred, and now all we have to do is get through the soft landing. I think that that's premature. So when we look at new highs on the S&P, I think that probably continues unless the labor market shows signs of weakness. And we've heard commentary from Fed speakers over just the last few days about how the labor market tends to weaken very quickly, especially after the beginning of rate cuts and during an aggressive cutting cycle. So as Guy and I have been talking about for a while, usually that unemployment rate, when it starts to turn up, it picks up speed very quickly. We don't know the answer to that yet. It hasn't picked up a lot of speed yet, but we're still just right at that turn.
Yeah, without question. I mean, it's escape velocity type of thing. And it's not just Elizabeth and I that have talked about it. I've heard Larry Summers talk about it. I've heard a lot of different people come out and say once it starts to move, it typically doesn't stop where, in this case, the Federal Reserve wants it to stop. Now, my sense is, they'd be pleased if it got up to 4.5%. I think they'd be okay at 4.7%. But anything sort of north of that, although I think the historical norm is probably closer to 5%, my sense is they start to get a little bit concerned. But, I'm one of these people that don't think rate cuts is the salve for the employment picture that a lot of people do. We'll see. By the way, what's interesting, Dan, and we've talked about this, rates have actually gone higher since the Fed cut rates. And this steepening yield curve suggests, as Elizabeth says as well, it's a bit of a harbinger of not necessarily good things. So we'll see. Let's take a look at the triple Qs, Dan, because this is sort of your ballywick. Again, unlike the S&P 500, we did not make a new all-time high yet like we did back in July or thereabouts. But here we are. It feels as if some of these semi-names have found themselves back on terra firma. We teased Micron earlier. We'll talk about that. I think a lot of it is based on the fact that, NVIDIA is not sort of falling out of bed. And I think the news that Jensen Huang who was done selling stock, I think that's what probably got it on its horse a little bit yesterday.
Yeah, interesting enough. I mean, the NASDAQ lagging, we talked a little bit about it yesterday. If you look at the equal weight S&P, the RSP, it's only up 12% of the year versus the NASDAQ that's up nearly 20% of the year. Look at the Russell 2000, it's up 9% of the year. So, there's some indices lagging, including obviously the NASDAQ. The NASDAQ's up less than the S&P. That's not a condition we see too frequently, especially when you consider the earnings contribution of these top 10 names, the S&P 500. The narrative is that it's broadening out. So the question is, if it's broadening out, then, are any of these sectors, or put them together, equal to the earnings contribution of Microsoft, Apple, whatever the hell you want to throw in there? And I'd say no. And so I just don't know if this market's broadening out with like energy and I think it's concerning that utilities and XLP staples remain big. You know what I mean? It's concerning that whether the stock market goes up or down, gold makes new highs every day, and when I say concerned, I'm just like, what is the scenario that can keep the stock market just blowing out to the upside? Because investors for a day last Thursday were pretty excited about a larger than expected, a Fed funds cut. But I think to your guys' point, if we get to the Fed's target by year end of unemployment at 4.4%, the question might be, how far does it go? Does it get to 5% or so? I do think it's interesting. We were talking about the Somm rule, right? Well, Miss Somm, she
Claudia.
came out. What's her name?
Claudia.
Yeah, I'm just
Claudia.
being polite.
Yeah.
That's her married name, by the way.
Somm?
Yeah.
Oh, interesting.
Well, so her husband's loving this, like his time in the limelight. You know what I mean? I just think it's interesting that I think that she got uncomfortable one day when she started hearing her rule all over the place. And then she was like, picks her head up, like, whoa, hold on. You know what I mean? It's like, I'm not sure this is what you think it is, Liz.
Well, you know what I thought was funny about that is it did seem like she got uncomfortable, but the reality is that her rule has really been pretty accurate. So she got uncomfortable and she pulled back and said, well, it's not necessarily fail safe. It doesn't mean that there's absolutely a recession coming. There are some conditions that are different this time than some of these prior cycles. But the reality is her rule has worked. So of course, I've said this before, things that have never happened happen all the time. It's possible that her rule triggers and there is no recession. But I would have liked to see her be more confident about it and say, yeah, you know what? This is concerning.
Yeah. Guy, are you concerned? I mean, listen, you've been talking.
Yeah, I am. And, it's interesting Liz says that. And I've never met her. She's lovely, I'm sure. I don't know. I'm not quite certain why she's backing away the way she is, somewhat reticent. I get it. With all that said, I think the optimist will say one of the reasons it may be different this time is we're coming off such a ridiculously low base that maybe, that is some of the mitigating factor. I mean, historically, when this has happened, unemployment rates probably been significant higher, and there have been different conditions in the economy. I look at this and say, my God, this is typical late cycle behavior that the market's not picking up on. And Liz talks about that all the time as well. I would submit, maybe more so than ever, I think her rule is going to sort of hold true. But we'll see how it plays out. I mean, there's a lot of time left, a lot of shot clock.
I'll tell you exactly what people's take on it is that the unemployment rate has gone up because the labor force has grown, not because layoffs have picked up. So that's what's different about this cycle. So yes, it's come off a really low base, but we've just increased the number of people available for work, which makes the unemployment rate look higher, but it's for good reason. We're increasing the pool of labor. So I get that. I understand that completely. And it may be that this cycle, at the end of it, we say, well, that was different. Yeah. And that is what changed the way that we read this data. Oh, just to bring it back to the market for a second, because Dan, you were talking about this before, the sectors that are leading and what has to happen to take the S&P higher in this environment. Some of it is starting to happen. But to your point of, if you've got an S&P that's going higher, tech is not pulling its load, but utilities and staples are, that doesn't really feel like a broadening out cyclicality in the economy. What you want is cyclical sectors to lead, things like industrials, financials, maybe even materials. You want to see discretionary get up there. So in a trailing 1 month period in the S&P, discretionary, utilities, and industrials are the top three sectors. So utilities still up there, but it is encouraging to see discretionary and industrials in that top three spot. Over the trailing 3 months, real estate, utilities, and industrials. So again, encouraging to see industrials in that top three. Still concerning to see utilities and real estate up there.
Yeah, yesterday we took a look, Liz, you were not here with us, at the BKX, so the banking index. And Guy, we kind of highlighted what looks like some pretty decent resistance in this. Maybe Amanda can bring it up. It's, not far off it. We're 1.5% or so. I think that high was 116. Here we are at 112.5. It's been a pretty nice uptrend. You see that 150-day moving average that's kind of holding. But it's interesting because is JP Morgan has also lagged the broader money centers off the bounce off the lows in the last couple of weeks. And I'll just throw that out to, crowded trade. And, Jamie Dimon continues to be a bit more cautious than many of his compatriots who run these big banks, guys. So that's also a sector I think makes sense to keep a very close
over and over again. He's had every opportunity to sort of backtrack. And now this is probably going back 18 months to almost 2 years where, he's been sort of putting those warning signals out there and the market's been looking past them clearly, but he has not really backed away from any of this stuff. And I find it really interesting that he continues to sort of raise concerns that nobody else is seemingly want to acknowledge. So I'm glad you brought that up, number one. And it's going to be interesting to see what happens with these banks here. I mean, there are a lot of people that want to make a constructive argument for banks with the steepening of the yield curve, a number of different conditions, obviously the Fed lowering rates. Theoretically, it should be supportive of the economy and what have you. I'm not one of those people in those camps. I think in terms of valuations, some of these banks have gotten ahead of themselves, JP Morgan being on the top of the list. And I think we're entering a climate where it's going to be sort of, it's going to be trouble. It's going to be difficult for banks to perform the way they have in terms of the stocks. So that's just me. We'll see how it plays out. But if you look, this JP Morgan chart, as Carter likes to say, the 150-day moving average is your trend line, sort of 200-ish, and I hate round numbers, but in this case, that's how it plays out, is sort of your line in the sand.
Yeah, no doubt. All right, let's get to something that's on the tip of Liz's tongue. She has a note that comes out every week. We get to preview it a little bit. That is her blog. You can go to, what is it? SoFi.com.
On the money.
Hold on. / on the money -- money. And you can get it right there.
I'm not sure you've said it right once.
Go ahead. SoFi.com.
Anyway, you can also just go to my Twitter feed and find it very easily, or you can just go to www.sofi.com and click on investment strategy.
Guy, what did you used to say about Liz's Twitter feed?
Well, if you're not following Elizabeth on Twitter, you're doing it wrong. You just why even bother being on Twitter? She's
by the way,
fire emoji.
Lots of people are doing Twitter long these days, if you think about it. All right, Liz, walk us through what you were focused on here. Because, hey, really quickly, before we get to this, let's pull up the chart of the FXI. Because, yesterday,
mind the gap. Look at this thing.
A pretty powerful move, and again, it's a bunch of stimulus. And Guy and I were talking about it on Fast Money last night. It really felt, first and foremost, a lot of that stimulus was focused on their markets, rather than the economy. But that sort of gap is pretty powerful. If they can pull up, a multi-year chart, because this is the one that really kind of gets your antennas up a little bit. But the reason why we said mind the gap is if the FXI was to fill in that gap, that would be super bearish, Guy, right? They're going to need to take out a bazooka, as the folks like to say, when it comes to stimulus. So that looks pretty great, but on a near-term basis, you better hope it doesn't fill in that gap, Liz.
Yes. So the FXI is the China Large Cap Index. So this week I wrote about China and about the stimulus that they announced earlier in the week. The piece is called Hoist the House. So talking about the stimulus, first of all, what did they announce? They announced that they were going to allow consumers to refinance at lower mortgage rates. The estimate for that is about 50 basis points lower. They started an asset swap facility to be used to support the domestic equity market. There's a $300 renminbi billion program for corporate buybacks. So that's to support, obviously, the stock market as well. And then it's possible that the People's Bank of China will open a national stabilization fund. So when you hear all of that, first of all, I think one of the takeaways is their stimulus sounds a lot different than what we would do in the United States. And there are a number of reasons for that. So let's talk about this first chart. This is an illustration of what the problem is. Okay. So in the red and green, that's what we're showing as PPI. That's a measure of inflation. And Guy, you talk about this all the time. PPI is more indicative of the economy, CPI more indicative of the consumer. So we're looking at China's PPI. You can see that recently, ever since late 2022, actually, it's been in deflation territory. So this is an indication that underlying demand in the Chinese economy is weak and deflating. And then that blue line that's overlaid is Chinese retail sales also falling. Now, this is intuitive in the sense that if prices are falling, it's difficult for companies to keep nominal sales up. So you're going to see retail sales fall. Also difficult to have a positive GDP reading without a consumer who's spending money. So then we look at, but what's the difference between China and the US? We're used to talking about the consumer as the only thing that matters here because it drives so much of our economy. So that's what we see on the left-hand side of this chart, that blue box. In China, the consumer drives less than 40% of their economy. The majority of their economy is actually driven by what would be called gross capital formation. So that's things like spending in government, spending in businesses. So that's why you're seeing so much propping up of the domestic equity market, trying to prop up businesses, because that is what drives a lot of their GDP, and exports a tiny little piece as well. So then if we keep going, now we know what the problem is. We know what China is sensitive to. Looking at this chart, this is how we tie it back to the market. Why are they stimulating equities? Because we talked about their PPI being in deflation. If we look at the economy based on a GDP deflator, which is basically the difference between nominal GDP and real GDP, their GDP deflator also in negative territory. Stocks tend to follow the GDP deflator. So that blue line is the Chinese stock market. And then you say, well, this is only one instance, one country. And I'll show you the other country that we've talked about a lot recently, which is the next chart, Japan. There's their GDP deflator in the magenta line, and then their stock market in the blue line. You can see as their GDP deflator was negative through 2012, their stock market also under pressure. As soon as the GDP deflator started to turn positive, that was Shinzo Abe's policies coming into play, the stock market also turned positive. So the reason for showing this is that if they don't get their GDP deflator up, driving business investment, driving the consumer, their stock market isn't going to go anywhere either. And then we talk about the Chinese economy a lot as it pertains to housing. Their housing is way under pressure, also been in deflation for a long time. If they don't get that out of the water, the economy is also not going to go anywhere. And there was an estimate from Goldman Sachs today. Basically, the housing market needs 8 trillion renminbi of investment in order to get rid of the slack. This proposed program only takes care of about 4 trillion of that. So they're only halfway there. Bottom line, the stimulus is great. It's a good sign that they're willing to do it. Probably not enough.
It is fascinating. It's interesting. They basically created, it's been in place for a while, I'm sure, but their own version of the plunge protection team. And they are going to fight tooth and nail to sort of keep away from what Elizabeth just talked about, and to try to prop up, not necessarily their economy, but their markets, which I think people would take. Maybe they'll make the reach that the markets are, in fact, the economy. I'm fascinated to see how this plays out, because this is sort of pushing all your cards into the middle of the table. And, they're doing that with sort of a 2-7 offsuit, as Danny Moses would say. And they're going to flop, another 2 7s and maybe a 2 and get a full house. I think the probability of that is really low. We'll see how it plays itself out without question. You're right to bring up the FXI. I mean, that's it in a very short term. Look at it in a longer term. I think we had a chart up, and you'll see sort of where we've been and where we are. It's going to take heroic efforts to sort of get this thing off the mat. And, we'll see how it plays out, Dan. But, I'm optimistic in some of these individual names like Alibaba, because we've seen trough to peak moves of sort of 25 to 50% along the way. But, this to me is them basically saying, we got nothing to lose here. We're going to go all in. That's just my take. Maybe I'm a bit too hyperbolic, but I think that's effectively what's going on.
No, I think you're right. I mean, Alibaba did not make a new low from, the low that you see right there. It's right above that moving average for the first time in a while. The only thing I'll just say is that, if a lot of these moves are meant to, buoy the Chinese consumer, then it makes sense. Like some of the best performing stocks yesterday were Alibaba, Pinduoduo, JD. These are all consumer oriented names, and we know that there's been very weak demand, but we also know that, the big problem is not like consumer balance sheets. It really is this, well, it might be related to it, is this property issue, right? Mm-hmm. And so they have this huge bubble there. It's suppressing growth. The Chinese economy is just in the shitter right now. So I guess I'm more focused on what does it mean for U.S. multinationals who are depending or have been depending on China in, this emerging middle class that we've heard so much about over the last 10 years. Growth there has really come to a halt. We have a ratcheting up of a trade war. We have a dollar that's weakened substantially. I think that's going to be a story as we get into Q3 earnings and start thinking about Q4 guidance. What does a weak dollar mean? It was something that was helpful helping out a lot for international sales and the like here. So again, I think the China situation, or at least the ties between us and them, probably don't get better anytime soon before we know who's going to be our next president and what the tone is going to be between us and them.
Yeah,
Real quick. So go ahead, Elizabeth.
I was just going to say the ways that we already know it's affected U.S. multinationals is in some of the luxury goods. It's also affected European luxury goods companies, that there just hasn't been that demand from the Chinese consumer. And then I think, Guy, you and I have talked about this before. China's been in this deflationary spiral. If they continue in a deflationary spiral, it ends up being deflationary globally. So if that continues to be the problem, then obviously there's going to be pain to be had elsewhere. What they're trying to do is stop the deflationary spiral. So what I would want to see them do, and what would make me more constructive on the China story, is if they continue to announce more and more stimulus that's more broad reaching and things that would drive inflation finally out of that deflationary level.
And I didn't take geopolitics in college, so I'm not going to pretend, but I have actually read books before, hard to believe. And I'm also a big believer in history repeating itself. And when countries are typically backed into a corner, and you can go back and look historically, I mean, look at World War II, for example. That's when they sort of lash out and last ditch effort. And that's what leads to sort of altercations that nobody wants. And I've said for a while, and there are other people that actually sort of agree with this or have the same point of view, that when backed into a corner, China is it's most concerning on the China, maybe Singapore front or the China Taiwan front, that nobody seems to want to talk about or bring up. So keep that in mind as well. And just throw up two stocks real quick that I think sort of play into this as well for different reasons. Look up at John Deere and think about what former President candidate Trump said. I think it was yesterday. If John Deere were to move their manufacturing to Mexico, he basically said they're going to slap a 200% tariff on. I don't even know what that means, but look at John Deere longer term. I know what a 200% tariff means, but it's a little, again, hyperbolic. But look at the amount of times we've sort of pushed up to these levels, Dan. And this goes back for the last couple of years. So we've been bouncing up against this prior all-time high a number of times. It's either building a base to the next leg lower, or this is a top of all time. And Caterpillar is another name, similar but different. We just basically traded up to the prior all-time high we made recently. Again, something to watch in terms of these two stocks. And you can see, again, that prior all-time high, I think in January of this year-ish. So again, two stocks that I'm watching very closely, Dan, Nathan.
Yeah, I mean, we don't have to debate the politics of this because it really is politics. It's not exactly policy. But if you look at a company like Deere that has negative earnings growth this year and expected to be next year, and that's also negative sales growth, there's obviously issues there. The stock trades well below a market multiple at about 16 times this year, about 18 times next. I mean, at some point, these companies have to figure out how to operate properly, right? And so, NAFTA. Remember all that crap and this and that, whatever. But a lot of these companies, you want to threaten 100-year-old or maybe longer, U.S. company with those sorts of tariffs, figuring out how, listen, this goes back to the tariff war, the trade war. That just makes this stuff more expensive for U.S. citizens when you start thinking about that sort of stuff. So again, we made this deal, and you could say it was an unholy deal 50, 60 years ago to outsource our manufacturing. But, you reshore the manufacturing of iPhones here in the US and all the difficulties of putting the supply chains together, where all these components come from and all this sort of stuff. You're talking about $2,000 iPhones, you know what I mean, for US consumers. So again, I just think to try to do this with one fell swoop of a trade war, and this has been going on now for a while, is probably not the answer. And it ends up being a huge drag on our economy if you think about it, because it really hurts manufacturing here if the input costs go up that much because of disrupted supply chains and tariffs.
We have a lot to talk about still. Let's throw up the yields real quick, because as I've mentioned a number of times, since the Fed announced they were lowering rates by 50 basis points, the TLT has basically only gone lower, meaning that rates have gone higher. And that's obviously lending or leading to the steepening of the yield curve. But, I look at this and say, watch out. I mean, that might have been another one of these bell ringers in terms of the low for yields, at least the yields in that duration for quite a period of time, Elizabeth.
Absolutely. So we've got a 2s 10s curve that is now positive By 23 basis points. It's sad that we think that's a big number, but after being inverted for so long, 23 basis points positive does feel big. Now, I think some of this makes intuitive sense, at least in the near term. If the stock market has decided that a soft landing has been achieved, or at least we're pricing that in as the base case, the bond market is doing some of the same. So we know that the Fed is going to continue to cut rates. We're a little undecided on the speed and the magnitude of those cuts through the end of the year, but the 10-year rising, so yields going back up and seeing a little life in the US, I think is a response to saying, okay, maybe a soft landing is more likely, or maybe a 50 basis point cut to start this all off made a soft landing more likely. So then yields stopped pricing in so much certainty of a recession. Now, I don't know that they're going to stay there. And in fact, as I mentioned earlier, I still think that this might be a stop at balanced on our way to weak, in which case yields would come down across the curve.
Yeah, it's interesting. There's an article in Bloomberg this morning talking about holiday shopping, online holiday spending. And this is from Adobe. They put this report out, I think, every year in the lead up, and then they follow it up on the way out. And they're talking about maybe 8.5% growth year over year. This would be the biggest increase since 2021. They're talking about, though, you can see it in the article here, very promotional. I think every holiday season over the last 10 years online has been very promotional. Those Black Friday things start, 2 weeks before Black Friday, and they go right through Christmas and the like here. So, they're talking about inflation inputs down. They're talking about, huge discounts. That doesn't really tell us that much. I mean, but, who knows? Let's move to this. I don't think we have much to add on that, but it's worth noting that expectations are high, heading into that. Downgrade guy, GM and Ford. You've mentioned this on a million occasions. These stocks have not gone anywhere for decades. Our friend Doug Cass at thestreetpro.com, and he's also Seabreeze Advisors PM and over there. He had a note out today, and maybe this is a bit old school, but I'm going to the perfect guy to kind of opine on it, guy, if it's old school. He had a note out this morning, so goes GM, so goes the market, and I'm just curious. I mean, seems like from Adam Jonas at Morgan Stanley, very specific call about the auto industry that might be able to be bifurcated from the economy, but just thoughts there.
Well, I mean, that's Adam Jonas's. And listen, the Ford downgrade is what it is. The GM one is a little more interesting, I think, given where the stock is just traded up to. So throw up a GM chart there. There you go. You'll see where we just basically rose to a couple times up at these levels. We have failed. We failed there miserably, obviously, July into August. We traded back up to it. And now here we are once again, right at the 150-day moving average. If you go longer term, you'll see that this has also been a very difficult level. So I admire this downgrade. And, maybe there's something to that in terms of what Doug said. As GM goes, so goes the broader market. I haven't looked closely enough. And, GM and Ford have sort of been left sort of to the wayside. Ford, however, is a much different story. I mean, it's effectively been flatlining for the last couple of years. So if you put up a 5-year chart of Ford, you'll see, we've had bounces along the way, some sell-offs, but, we're probably trading $10.50 or so of Ford. I mean, that's basically where we've been since the summer of 2022. And that is not all that interesting to me. And that's a company, again, if you think about what's transpired over the last decade, 15 years, stock market only has gone higher effectively-ish. And, it's probably been the golden era for auto sales in terms of what's going on. And these stocks cannot get out of their own way. So I'm more interested in the GM one than the Ford, because I think Ford, as Carter would say, is, a pair of twos at best. But it is interesting to see at this stage of the game, it's somebody like Adam Jonas with the gravitas that he has come out with a call like that.
Yeah, I mean, for a long time, our economy was so dependent on manufacturing. We were looking at companies like this, including Deere, including Caterpillar. And I think the bulls of today would tell you that this stuff matters much less than it used to, and that they're not as good of indicators of economic activity. And in some ways, that's probably true. But the reality is, especially for vehicles, semiconductors are now in every car, and it does matter. So looking at some of this stuff, and perhaps Detroit or Motor City is no longer the emblem of success for the United States, but this stuff does matter. It is an indication of consumer demand. It is an indication of what we talk about all the time as durables. So we have to watch them as bellwethers. We have to watch them as an indication of sentiment.
Speaking of semiconductors, this is a memory company. It's Micron. We were talking about it a little bit yesterday, Guy. We talked about it in Fast Money last night. And, we've been kind of all over some of these kind of, the adjacent trades to the NVIDIA. Obviously Gen AI, these chips, the high-end chips, they go into the servers, that go into the data centers that train the large language models. And then people are going to, once we train it all, we got all the history of the internet in there. Then they go into the inference phase, and that's going to be cheaper. Listen, Micron, Dell that makes the servers, Supermicro who makes the servers, we've seen all of these things round trip for the most part, right? So when Micron joined the party, it was something that people weren't focused on memory, how much more memory it was going to take in these servers, right, to work with these high-end GPUs. Well, look at that, man. I mean, talk about an all-out mania here. So we see, I was looking at this, like the average price target, is $145 guy, 12 months. There's 38 buys, 4 holds, 1 sell. So despite that round trip, analysts seem to, be very bullish on this sort of story. Now, this kind of goes back to the NASDAQ lagging the S&P. So it means to me that there's some air coming out, at least from, the hyperscalers as it relates to this trade. The implied move, 9.5% in either direction. Listen, I think it's a hard press to the downside, okay? If you kind of think that they're going to have mediocre, results, the guidance better be bad, you know what I mean? Because to get this thing going lower, and to the upside, it probably wouldn't take that much for a beat raise guy to get this thing headed back towards that moving average.
People will look at Micron and talk about an evaluation. It's one of those companies where, you sort of throw valuation off to the side for a second, because this is historically a company that can be extraordinarily commoditized and at times somewhat ubiquitous as well. So I think you're right to point out that it's a hard press to the downside. But, I don't think people should necessarily be trading Micron here, because I do think it's a bit of a coin flip. Although I'll come out right now and say, given this sell-off and given the fact that we've held sort of that lower lender that we traded down to the August low and bounced, I mean, there's a higher probability for it to sort of trade higher from these levels. With that said, this speaks to the non-sort of widening of the NASDAQ trade. I mean, this is the complete antithesis of that. These AI adjacent trades, ex NVIDIA and a couple other names, have not done particularly well since basically late June, early July. And I think that is problematic. And if they come out and say something on the DRAM side of things where they don't see the demand or pricing is not what it should be, yeah, I mean, this stock could absolutely trade lower. We've seen it before. So it's not necessarily trading Micron. It's the commentary around it and what it means to that entire trade.
Yeah, Liz, you've been tracking the relationship between semis and software. And it's interesting because the next leg of this trade is like how some of these enterprise software companies might incorporate this technology, right? We already know Microsoft Copilot and what they're going to do with 365, but it really comes down to some of these laggards, Adobe, Salesforce, ServiceNow, Workday. They've been talking about uses of this technology, right? And kind of a little bit of an uptake from their customers. I just want to go to NVIDIA for 1 second, and then we're going to get to Butters here. And then I want to get your comment, obviously. Look at this thing, man. Amanda, she's just so good with those lines. You see, but she did screw up the colors. Usually for resistance, we use red, and for support, we use green.
That's fine.
I'm going to call that out. I'm just saying, I'm going to call that out.
Low, high, high, low.
Yeah, you see that 150-day moving average. You see where it's bounced here, but it's right up against that downtrend a little bit. So this is one that obviously we want to keep a close eye on, because I think as NVIDIA goes, so does the semis. How are you thinking about software versus semis?
Well, if you look at the comparison between software and semis over the trailing 6-month period, they've been kind of neck and neck since the end of August. And recently, semis have taken over again. I think that's in large part due to the optimism that we've got baked back in after a 50 basis point cut. We've obviously seen some optimism in that space, but I would be careful here. And we talked about this, I believe, on Monday on the tape, when we broke down the industry groups within tech, and seeing semis up 60% this year and software up only about, I think it was 15 or 16% at the time. If you're looking for bargains, the place to shop is probably not in the semiconductors that are already up 50 to 60% this year. So if you must be exposed to tech, I do think that there's probably better opportunity in the software space than in the semi space at this time.
Yeah, I just say this about semis. I think we're going to know a lot by what Micron says. Listen, it's not really going to speak to like GPU demand at this point. It might be demand from the server makers, that sort of thing. And so maybe everyone's been scurrying to get these, these high-end GPUs, and then it's the other stuff that comes. So it'd be really interesting, guy, to hear their guidance.
Ruth Gehrig, Ali, Babe Diedrichson, Zaharias, and John Butters. Dan, take it away.
The man, the myth, the legend. Listen, we get a preview of John Butters' earnings insight analysis. That blog drops every Friday morning in your email box. You can have it in your email box. Go to insight.factset.com/subscribe. All right, let's take a look at what John is focused on this week. He's doing the bottoms up target price for the S&P 500. This is a consensus. It's 62.82, up 9.6% above yesterday's record high closing price. Sector is projected to see a price increase of more than 12%. Energy, technology, communication services. Obviously, tech and communication services are kind of the same thing, but communication services has a bunch of the metas and the like there. Sector is projected to a price increase of less than 4%. Real estate, utilities, consumer staples. And what's funny about that is utilities and consumer staples, Liz, as we've discussed, are still two of the best performing sectors in the stock market.
Yeah, well, and maybe that's why they're expected to be lower on this chart. What's interesting? Okay, so the bottoms up aggregated price target 62.82 on the S&P. I believe the highest strategist price target, so top down price target, I believe is 6,100 right now, and that is one Mr. Brian Belsky, who just came out and raised his target. So it's fascinating to me that this is the target we're working with. In the beginning of the year, I know I'm sure you guys remember us talking about all of the strategists chasing the market up. Everybody had to adjust their targets. I believe even in spring, we started to see that chase go on. And then the S&P busted through many of those targets about halfway through the year. So I think this chase might be on a bit as well. This to me says that we're looking at a market that is pricing in cyclical recovery. We're looking at energy as one of the top performing sectors as predicted by this bottoms up research, and tech continuing to have its run. So pricing in a cyclical recovery and pricing in rates coming down without the economy feeling the pain.
Bottoms up suggests the math to me doesn't work. You add up all the things you say and say, holy shit, we're going to 6,300. And like, how are we getting there? And it's hard to reconcile. And again, just my opinion. So that earlier slide in the tease, Dan, Analyst 2, I forget what it was exactly, but Analyst 2 sort of optimistic. I think this bottoms up suggests exactly that.
Yeah. So going back to Micron, if we go to this next slide, it's kind of interesting. You see this list, the difference between median price target and closing price, top 10. The top 10 S&P 500 companies with the largest projected price increases are expected to see increases of 36% or more. Micron is predicted to see the largest price increase of nearly 60%. Schlumberger is the only company in the top 10 or for both price target increase and highest buy ratings percentage. So that's interesting, guy. I'd love to get your take on SLOB. We call it SLOB, right? Can we still call it SLOB, SLB?
Yeah, no, I think now it's SLB Corp. I don't think they call it Schlumberger anymore, but I digress real quick. It's interesting. Oil services have obviously fallen on hard times for a myriad of different reasons, and it makes sense. So I still think they're run better. They have better balance sheets, and you can absolutely make a case for a lot of those stocks on valuation, but the market is focused on other things right now. So I totally get it. I've said for a while, and I'll stand by it, I think once there's a rotation out of technology, one of the sectors that's going to benefit is energy. We'll see how it plays out. I've been saying that for a while. It hasn't happened. In terms of Micron, real quick, I mean, it just speaks to exactly this. The market is way too optimistic. Now, these people looked like geniuses about 3 or 4 months ago when there was this whole AI adjacent trade going on, and Micron actually got to their price target. It looks a whole lot different now, Dan.
Yeah. So interestingly enough, I mean, analysts did not move their targets or their estimates for that much down from those highs a few months ago, Liz. So you look at a Micron that is expected, okay, the target's 150, the stock's, below $95. It traded as high as I think 160 a few months ago. So no movement there. So now the expectations are to get all the way back there. It's going to take a lot here. You know what I mean? When you, lose 40%, you know what percent it takes to kind of get back there. So again, 60% doesn't even get it back to those prior all-time highs.
60% is a big move in one single company. And much like you say, the guidance would have to be pretty bad to bring it down. I think the guidance would have to be really good to bring it up, unless we're counting on this as just pure multiple expansion, which I think we've we've all but exhausted the multiple expansion in the market at this point, and now it's time for fundamentals to back it up. I do find it hard to believe that we're going to see 50 to 60% in some of these companies.
All right, couple questions real quick from Donald Clayton, and we sort of address this. I'm reading, so apologize for my eyes looking away. Is it too early to put on a TLT position? From my view, the world looks like it's in a deflationary trend. I think what you're saying is it too late to play TLT from the long side? And actually, you've gotten a bit of a break recently because the TLT has sold off over the last week. So the short answer is I don't think it's too late through that lens. I'm of the belief, though, that TLT is going to continue to go lower, which is somewhat counterintuitive. I think it's going to go lower for other reasons because I think, again, the rush for our bonds, given the amount of refinancing we have to do on the treasury side of things, is not going to be as robust as the market thinks. That's just me, Dan, and Elizabeth.
All right, Liz, walk us through this. So the TLT is the ETF that tracks the U.S. Treasury 20-year, bond ETF. So if you're buying it, you think rates are going to go lower on the long end, right? And so he also said deflationary period. Does this make sense to you? And where are you on this? Because I think Guy's been making this point for the last week since the Fed cut, is that we've seen rates on the long end kind of move back up a little bit, right? So maybe the market, at least in the yield market, has kind of moved ahead of what the Fed's going to do, and now they're going to be data dependent, and who knows? So curious to your answer to this question.
Yeah, so I am concerned about global deflation. If I were going to try to play that, though, play volatility in the treasury market on the expectation that we do see more deflation, I'd play it in the 10-year, not the 20 plus. I do think that the 20 plus is probably going to see further fall from here, but the 10-year, because there has been a rise in 10-year yields, and I'm looking at 10-year break-evens right now, there's also been a rise in 10-year break-evens just in the month of September. And what does that mean? That's the rate at which you're indifferent between an inflation protected security and a nominal security. So the 10-year break-evens are expecting inflation actually to rise a little bit here. I don't think that that's necessarily going to be the case either. I think we're going to go through more of a reduction in inflation, but I think the 10-year is a better place to play that.
30 Fit J13. Where can I get that gray blazer that Dan wears? Dan?
Ooh, great question. I get lots of compliments. I have 3 of that exact same blazer, and so you don't like it in the blue, you don't like it in the sort of denim-y, but you like it in the gray. There's a company or a shop called 11T. I think it's ELEV or something like that, TY. Maybe Jacob can pull it up there, but great stuff. I really like it. It's unstructured. It looks a little casual, so I can wear it with jeans, maybe a t-shirt underneath it, but I could also dress it up and I could wear, a button-down shirt with it. I don't wear ties anymore. Like Guy, I might wear it to a bar mitzvah or a funeral or a wedding, but I'm not likely to wear a tie for this program or for CNBC anymore.
As Yogi Berra said, you have to go to other people's funerals, otherwise they won't go to yours, Elizabeth. I know you like that. This is for you. Who do you think will finish runner-up behind the Vikings in the NFC North? Obviously, already giving the Vikings. Yeah, this guy is obviously a Viking fan.
I have no idea. I focus on the Packers and the Packers only. And actually, I did get asked by a 6-year-old last week if the Vikings played the Bears, who would I cheer for? These are 2 rivals of the Packers, and I chose the Vikings. So I suppose if I had to choose one, I guess it would be I don't know who's going to.
Well, I'm a Lions guy. I like Dan Campbell, but since Elizabeth is a Packer fan, by default, I will root for the Packers of Green Bay.
I mean, we did it again with the backup last week. So
listen, they're playing good football. I mean, there's no question about it. You got to like what they're doing there. And the coaching staff, which I was questioning, is actually coming around. And now one has to say maybe Mike McCarthy was the problem all along in Green Bay, because you see what's going on in Dallas, Elizabeth.
It's pathetic.
Wow.
Hey, by the way, this is a really sad note to end on maybe. My wife was reading this to me yesterday that Brett Favre has been diagnosed with ALS.
Okay. Yes, you're right.
And he thinks that he's had 1,000 concussions. Think about that. That's insane. Well, we're wishing him good stuff.
Yeah, well, except that he was doing it yes, obviously. It's upsetting. But he's also been sort of accused of things that are somewhat unsavory. And the fact that he mentioned it yesterday, testifying about, prior to some of the accusations against him, I find a bit problem. If you're trying to curry sympathy, there's a better place to do it. Although, yes, I am sympathetic to that. It's an awful disease. Muhammad Ali suffered from that. And I think I find that, I think brain injuries to that extent go one of two ways. I think a preponderance of NFL players suffer from ALS, and I think that's a function of brain injuries. And the other side of that is Parkinson's. So I am sympathetic.
No, of course.
I don't like the way he did it, though. There
you
go.
So Bill, our main man, Bill Hockman over here, funny guy too, Guy.
Very funny.
So he says.
Says. I mean, it's our problem. We haven't gone to see him.
True.
But we're gonna get there. We were talking about Norm Macdonald, who's like a goat when it comes to comedy. He's obviously Bill's all up in there. He passed 3 years ago. And he had Lou Gehrig's disease, and he didn't tell anybody for 10 years. For 10 years. Isn't that interesting? So, we were talking about that before. And so it's just interesting what you just mentioned about Brett Favre.
Handled it
Favre. Well, that's it. By the way, I think the magic level, if you're looking for an engulfing pattern, I think 5704 in the S&P closed below that, given we made a new all-time high today. I think that's something to watch, Dan. I continue to watch the TLT, obviously Micron after the bell. We will be back tomorrow, Thursday, I believe, with Carter Worth or not. By the way, Market Matrix, we're like in our third year of that. I'm kidding.
Yeah.
Seemingly with third year because it started a long time ago. So check that out. And subscribe to the Risk Reversal YouTube page and smash the shit out of the like button. Why wouldn't you?
Yeah, rate it, review it, share it. That's how people find it, Liz.
That's right.
All right, everyone. This was really fun. Liz, thanks for being in the studio. Guy, I'm going to see you at CNBC's Fast Money.
Yeah, I'm headed there now.
Yeah. Thanks for everyone being here. We'll see you tomorrow. Carter will be with us. See you later.